Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. It's summertime. I'm joined for the sixth time. He's basically a co-host at this point, my buddy Wes Gray. Wes is the founder, CEO, Co-CIO of Alpha Architect, who leads the ETF Architect team. Wes always brings a friend. This time he's joined by Srikanth Narayan, founder and CEO of Cash, which he started in 2022. After experiencing concentrated stock positions on his own portfolio, previously he served in engineering, product leadership positions at Uber, Alphabet. Gents, welcome to the show.
Thanks for having us, man.
Thank you so much for having us.
All right, this is going to be a lot of fun. Long-term listeners, you've probably heard me talk about a certain number a lot in the last year, 351. No one else in the world besides the Meb Faber Show listeners, I think, know about this, by the way. But Wes, Bob Elwood, and I did a deep dive conversation last year, and we've done a few follow-ups and kind of broke this really cool idea and news about the conversions. We got some big news today. Wes, what are we talking about?
Yeah, so you kind of broke the news on 351. How do I get my portfolio tax-free transition to a beautiful, low-cost, tax-efficient ETF? But as you know, the problem is it has constraints, and you got to contribute diversified property. Well, as you probably get, what happens if I got 100 mil of Tesla or 100 mil of Amazon or whatever the heck it is? 351 can't solve that. But Sri and his team at Cash have come up with a solution where now we can solve that. So it's going to be a big deal as we move this forward.
What a great lead-in. Listeners, you got to listen to the whole show. We're going to back it up a little bit. I'm going to call you Sri. That's way easier. I've actually mentioned you a few times on the podcast, even on Bloomberg, because your company, first of all, the biggest compliment, beautiful website.
Thank you.
I think this is usecash.com. Is that it?
That's correct, yeah.
Beautiful website, listeners. We'll put the link in the show notes. But let's back it up. What caused you to start this company and lead into a little bit of what it is you guys do?
I like to joke that I was working at Waymo building self-driving cars, and one day woke up and decided to be an asset manager. Unlike both of you, I don't come from a world of finance, but I experienced concentrated stock positions in my own portfolio and wanted to solve that. Before I was working at Waymo, I was an early engineer at Uber and had a lot of my own portfolio that had ballooned to become concentrated in Uber. I had a wealth manager and tried to solve that issue in my own portfolio. And that's when I was introduced to exchange funds, got the pitch from the leading exchange fund provider. We were in the queue for over a year. We kept getting pushed back and we kept getting said that it was oversubscribed. And that's when I got curious about the mechanics of exchange funds.
One of the things you learn about the asset management industry, listeners, and this is true for a lot of finance, I learned this when I was applying to my first job. A lot of times you never hear no. They either just stop responding to you or they're like, it's oversubscribed, right? That was like a polite way of, now that you know, you're like, oh no, they just didn't want my Uber because everyone else was contributing an Uber. There's only two choices, I think, Goldman or Eaton Vance. What were they trying to charge you, like 2%?
Yeah, so it's about 1.5 to 2% sales fee, I think, and about a 0.95 management fee after. So it is...
Classic Goldman. All right, keep going.
Yeah, it is an expensive product, but it has immense benefits. You take the stock that you're highly concentrated in, and you can diversify into a broad market exposure without incurring a huge tax bill. That seemed like the outcome that I wanted, and I was trying to get into it.
Give the listeners real quick what an exchange fund actually is. So for those people who just heard that and didn't listen to the prior shows, what is an exchange fund? They've been around for a long time.
The way an exchange fund works is you assemble a group of people that all have this problem, and each one of them contributes their stock. And if you assemble a diverse enough set of folks that have this problem in multiple different stocks, each one of them is diversified by virtue of participation. And IRC 721 says that there is a non-recognition of gain or loss when contributing to a partnership that is structured a specific way. And that structuring is where the exchange fund has a lot of nuances. You need to hold 20% in qualifying illiquid assets. The investor needs to participate for at least 7 years before they can redeem a diversified basket. You need to assemble the right set of folks, and each one of them needs to put stock in very specific proportions so that sum total of it is a diversified fund that is able to track a particular investment objective, like an S&P 500 or Russell 3000 or whatever it is. But when you're trying to build a fund, an exchange fund around the S&P 500, to look at it simply, S&P 500 has 11 different sectors that it breaks it down into. Technology over the last 20 years is up 15x, that particular sector. But you have sectors like utilities, real estate, or materials that are not all that much, and you have many stocks in there that have barely moved at all. When you're trying to put together this fund and say it'll match the S&P 500, you need to find stocks in all of these different sectors as well. But there's nobody holding low basis stock in those and trying to say, I want to diversify tax efficiently. That becomes the bottleneck, and you constantly have folks holding highly appreciated stocks in other sectors that are rejected. That was the initial insight that got me to thinking about like creating an exchange fund. And a little bit of background there, I used to work at Uber for a long time, and the team that I was working on was called Marketplace, which is essentially balancing the supply of riders and drivers and making sure that each city is well supplied and there's a equilibrium in the marketplace so that rides can happen very efficiently. It seemed like there is similar dynamics that are happening here, like the portfolio managers that I'm talking to on this particular product are not thinking about it the right way. So our initial product that we launched was around the NASDAQ 100. It is all technology. All of these stocks have had immense growth. Why don't we create a new exchange fund built around this particular index? And we also bet that there are enough folks that want this somewhat concentrated sector exposure, because the best thing from having 80% of your net worth in Meta, or the next best thing, is we can do a NASDAQ 100 exposure.
It's always funny with the concentration risk because people love hindsight bias, and depending on what year it was and what month and what day it was when these advisors say, no, Sri, we don't want your Uber, it may have worked out. Like, Uber has done well over some years, like in some years, not so much, and underperforming or outperforming. In general, it's hard to impress upon people just how bad an idea historically, on average, stock concentration is, right? If you look at all the academic literature, and I have to wave in Wes here because they write a lot about this. Brent Sullivan at Tax Alpha Insider also writes a lot of great columns about concentration risk. Historically, it's a horrible idea, but you talk to people. I remember talking to my mom back in the day, and I was helping her out with her portfolio and say, Mom, we got to get rid of some of this GE. Like, you have way too much in GE. And she's like, I can't sell it. Taxman's going to kill me. And then the old joke in the investing industry is like, eventually gets solved one way or the other. The market solves it for you because it goes down and you have no capital gains. Or historically, you just had to sell it and eat it. But you guys have seen a lot about stock concentration risk. Any insight there? Like, that's a thousandaire problem I have, right? I mean, my tiny little levels, but there's people out there that have 100 million, a billion, 10 billion sitting in one company. And the amount of times we've seen and written about on the blog over the years where there's people that go from a billion, 10 billion to zero, right? Where some of these things. Any insight, fellas?
I can just give you the quick quote on the stat that you're implicitly quoting, that Bessenbender study, where if you just said, hey, let's just buy and hold every stock over its lifetime and compare that to T-bills, what percentage of those actually beat T-bills? Not a lot. It's like 5% or 10% or something crazy. So the idea of buying and holding a security for a long time, especially concentrated, it's a terrible bet. You might as well put your money under a pillow. So yeah, that makes a lot of sense.
And another way to frame it to people, I always tell them, is say, look, let's say you didn't have 80% of your money in Uber and you could just wipe this tax discussion. and let's say you had $10 million, would you go put 8 million in Uber tomorrow? And everyone's like, no, of course not. Like, that's crazy. Why would anyone do that? And then like, well, that's literally the portfolio you have, right? Like, you have this portfolio that's insanely offsides, and it's like going to the roulette table. But people often who have made a lot of money from one stock or a handful of stocks, you get that emotional attachment where you're like, yeah, but this is different. This is Amazon. Hey, Meb, you don't understand. Like, I bought this. I bragged to my friends. I bought Amazon. I held it through the drawdowns, and here I am, and it's all my net worth. And the problem is, you don't talk to those people where that phrase was Enron, CMGI, on and on, right? Like all the alternate realities and multiverses where that didn't work out. Anyway, there's an enormous amount of research. We'll put it in the show notes, listeners. So go dig this up, because there's about a dozen papers and books that are really exceptional, and they all come to the same conclusion. It's a no good, very good, horrible, terrible idea.
I remember down here in Puerto Rico when I was talking to my soccer buddies, I was like, oh, so what do you guys do? They're like, oh, we do crypto. I was like, awesome. What do you own? Like, oh, BTC. I was like, well, do you do anything else? They're like, no, only crypto. I just diversify across crypto. I'm like, well, what about stocks, bonds, commodities? They're like, no. We diversify within crypto. So same thing here. Like, I own Meta. What are you going to diversify? I'll diversify into those NASDAQ 100 companies. So I think one of the things that's very unique about this exchange fund solution is that really diversification? To go from NVIDIA to NASDAQ 100, if you're a finance person, not really. So it'd be much nicer to have a vehicle where I could actually like contribute my NVIDIA and like really get at least some diversification into a much more broader market cap based index like S&P or what have you. There's obviously limits, but I think that's a pretty cool innovation that Sri and his team are bringing here as well.
Yeah, that's what we're here to announce, and happy to go into a little bit more detail about the new S&P.
We need like a big drum
launch.
roll, some music as we get to this. All right, who wants to take it? Let's hear it. What's the announcement?
Yeah, it's a simple announcement. We are launching an S&P 500 exchange fund, and we think of this as an enhanced version of the exchange fund that has existed for a long time. As I was talking to you earlier, there are inherent supply-demand imbalances with the exchange fund that bottleneck a lot of folks. Our new exchange fund will have enhanced capacity or more predictable capacity. It also has tighter tracking goals compared to historical exchange funds that tracked within the 2 to 4% range. And we also have much lower fee compared to historical exchange funds.
So all the listeners are like, hold on a second, Sri, hold on, Meb, Wes. You just told me that the problem with exchange fund is if you got a bunch of Uber, NVIDIA, you're pound sand. Like, you can't contribute it because no one else has any Duke Power or Chevron, or Berkshire's a bad example. I don't know. What are some other sectors? DuPont, whatever these stocks are. How did you solve that problem? Did you just go make a partnership with Vanguard to get all these old school holders? Like, how have you sourced, or how are you finding all these companies that Goldman and Eaton couldn't for the last 50, 60 years?
Think about an exchange fund as it's a partnership structure, and the partnership structure is porous, which means you cannot easily rebalance within the exchange fund. Our current exchange funds built around the NASDAQ, the only way they rebalance is by accepting new stocks from new investors to grow the portfolio itself larger and get the allocations that we want. But one thing most folks don't appreciate is that ETFs are able to rebalance very tax efficiently and be able to track an underlying benchmark very easily.
Yeah, so just to make the point clear for listeners, if you had 100 people to go into an exchange fund of days yore and it was all Mag 7 stocks, you couldn't, after you contributed, trade all those and rebalance into the S&P, because then you would have to go pay taxes, right? Like that would violate the 7-year sort of exchange fund structure. But the ETF structure, as we all know, is a magical vehicle. Wes, you want to talk a little bit about how that fits in?
Yeah, we've beaten this one with the dead horse, but under Section 852b6, we can always swap and exchange via baskets whenever there's a change in the portfolio decisions, and we can do all that without incurring taxes, which is why Vanguard, iShares, and everyone under the sun who operates ETFs in general never is going to distribute a capital gain because of this mechanism. It's just that, exchange funds up until now have never really got the reason like, well, heck, why don't we take advantage of that as well? That's because there's a lot of legal and tax work behind the scenes to solve the puzzle, but we finally got it.
Pom, pom, pom. All right. So listeners are like, well, still, I don't get it. You got exchange funds and you got ETFs. What's happening here?
The one thing to realize about an exchange fund is that you have a lot of folks that contribute shares, and what you assemble is a diversified basket of shares. And that's where Wes and Co have figured out how to do these 3-5-1 conversions to ETFs very efficiently and be able to transition a portfolio from a wonky portfolio that might have, let's say, 20 to 30 different stocks to an ETF that is able to track a broad index very precisely. That is what Wes and Co have been bringing to the market over the last year. And we met Wes about 2 years ago and talked about this particular structure, how an exchange fund could participate in a 3-5-1 transaction. It took about 2 years of research to get here, but we are finally here.
Yeah, I've been following you guys from the sidelines, and long-term listeners, if you go tease out, you may, if you listen to every word of every transcript, catch some hints to this idea, but never revealed until now because it's hard for me to keep secrets. But okay, so maybe walk us through a case study, an example, like how would this work or how is this going to work? We're recording this in the middle of May, near the end of May. How might this work going forward?
As you know this as well, Meb, 351 is beautiful because you can contribute a portfolio and you get a nice, pretty ETF structure afterwards. There's no lockups. There's nothing. You just move off in the sunset. But there's rules. And 351 has that follow-on treasury reg that whenever you contribute securities to a RIC, regulated investment company, i.e. an ETF, there's constraints. No single security over 25% of the total. And then there's this other 50% rule. But we'll get a situation like the following. Hey, I got 75% of my money in Apple and I got 25% of my money in other stuff. Great. I can kind of help you with 351 and we could contribute a block of Apple and a block of your other stuff, but you still got this huge Apple position and I just can't do anything for you. And there's a lot of solutions out there, but they're all going to be opaque, insanely complicated, and way overpriced, and you're not really going to know what you're going to buy. So, geez, I wish I had like a Vanguard version of exchange funds. Voila, meet Sri and Cash. Great. Now go talk to him, and then he'll be able to deliver that nice, affordable, transparent. You still got to comply with the tax laws, of course. But, now he can help you deal with this big block of Apple. And that sort of scenario is ubiquitous in our world. It's just the nature of things because you got power laws with certain stocks that go up 1,000,000%.
So let's say I got 100 million Apple. I call you up, Sri, say, all right, what can you do? Let's stay with Uber. J. Cal, you listen to
this? Yeah, so we are building an S&P 500 exchange fund and we're soliciting stocks that match that particular benchmark. So we get a lot of investors interested and we'll have, essentially it's a large jigsaw puzzle that we're putting together, but there'll be holes within that portfolio. In a traditional exchange fund model, because of these holes, you drive away a lot of other folks that are trying to come in because you cannot fill those holes and you're waiting until those holes get filled up. In our new model, we take this portfolio that comes in, it might be 80% there, 90% there, and we're able to take some of the portfolio and rebalance it using this ETF that gives us the exposure that we want. And these exchange funds will continue to onboard investors every 2 weeks, and new investors will come and keep joining, and those holes will get filled up over time. But through this ETF rebalance, we're able to get to the investment objective very soon and much closer than what a traditional model would allow us to do.
Let's say you start taking contributions just June 1, for example. How long would you leave that window open? Is it a factor of how much and what assets come in? Is it a set window of time that you may leave it open, subscription period?
On June 30th, we're beginning our first onboarding, and we're essentially going to pick investors that help us get towards this benchmark exposure. And the other part of the solution is that post the ETF seeding itself, the exchange fund will continue to onboard, and eventually a lot of these sectors that might just have a longer lead time will get filled in, and it'll track the S&P 500 as closely as possible using this ETF core underneath, as well as the stocks that we've built around it.
So one of the other things, this is like a natural complement, where because necessarily of the portfolio diversification requirement, we obviously get contributions that are much more diversified. And in many cases, we get full baskets of like dead, frozen tax loss harvesting portfolios where we already have like a good generic picture already of the contributions because we've been collecting contributions for a while. We already own every stock in the S&P and then some right now, just by the nature of like our efforts already. So, you know, the complementation of like, hey, on the exchange fund side, I'm going to bring a lot of these concentrated block things. You guys are already collecting 1,000 stock portfolios already with your contributions. It's this combination that really powers up the diversification capability, and it's a win-win for everyone. Because as you know, Mab, like the more scale we have in the ETF structure, that gives us the economic ability to drive costs lower, drive spreads tighter. Everything benefits from scale in asset management. And so I think it's kind of a beautiful marriage here of a lot of different technologies to solve like a fundamental problem for investors. How the hell do I get diversified tax efficiently?
Yeah. And so you're kind of leading into a really interesting comment. Earlier, Sri was talking about his experience with exchange funds, and there was a sales fee and then the annual fee, and we're talking into multiple percentage points. Cash already had started doing this, but you guys are coming in at quite a bit lower cost. Imagine not too popular at Goldman and Eaton Vance headquarters, but give us a broad expectation of what you guys are charging on this new offering.
So the exchange fund annual fee will be around 50 bips for most investors. It is a sliding scale depending on how much assets you bring in. We start at 40 bips for 25 plus million and 60 plus bips for 1 million. 5 million is 50 bips. We do not charge any sales fees, and the ETF fee is also inclusive of this 50 bip fee that we quoted.
That's an amazing point. Listeners, you hear that part. This is an inclusive strategy. What do you guys do with that 20% requirement? Where does that go? Does that just go into Wes's Puerto Rican, corporate projects? Like, where is this Vanguard or Apollo's private equity? Like, what qualifies and where are you getting that exposure and how?
Yeah. So as you might know, exchange funds require 20% in qualifying illiquid assets. There are a lot of asset types that qualify. The most popular are real estate and commodities. And even among that, real estate is the most popular among all exchange funds because it has a cash flow generative nature. The way exchange funds have operated in the past is they go out and buy buildings in second-tier cities around America, multifamily residential or industrial buildings. When we started off with cash, we had a blank sheet of paper and we looked at how we can solve this more efficiently. Are we going to be a real estate manager and a good one? Unlikely that we'll be able to get there. How do we get access to the best real estate managers across the country and be able to get this exposure in a way that is diversified from day one and is much lower on the risk spectrum? So we've invested with multiple leading real estate managers, and we are an LP into their core diversified funds. Most of these fall in the Odyssey NCREIF index, and each of these funds is anywhere between $10 to $30 billion of thousands of properties across the country.
Okay, so not the little projects in Puerto Rico, sadly. And what is the illiquidity? Is there like a broad illiquidity rule or requirement? Like, what does it even mean to be illiquid in this sense?
Qualifying illiquid asset, if that's what you're asking, it is not cash, it is not securities. it is essentially a rule that excludes things that are considered liquid. And when you go through that, talks about all of these are considered liquid. Anything that is not included is illiquid.
This is exciting, listeners. So I'm going to try to summarize this like a little quicker. We have this amazing product development, which is essentially the best of exchange funds and 351. Somebody's so excited they started barking. We once did a podcast in Hawaii that had roosters in it the whole time. Yeah, so you have this amazing complement, which is the exchange fund as well as the ETF structure, really to solve the highly stock concentrated challenge that many investors have, which can be portfolio destroying. And listeners, by the way, both Wes and myself have partnered with Cash. So Cash has these kind of market cap weighted S&P, NASDAQ style indices. Wes will be doing one of his strategies, so a slightly different, I wouldn't say spicier, but a Wes take on a new fund launch. And then we have another 3 funds lined up that are strategies that would be slightly different than market cap weight too. So there's a whole buffet coming out, and depending if you guys want to hit the seafood part, the salad bar, or or the sandwich bar, depending on your interest. What have we not touched on, y'all? I feel like there's a lot more we could go into, Wes.
Yeah, one thing I just want to hit on here is the cost, because I think that's a very important point here. Because if you look at across the landscape of like tax minimization, it's usually extremely opaque, extremely complicated, and extremely expensive. And so I've kind of determined, generically speaking, like in order for these things to work, like if you're going to charge fees, like the main benefit here is tax deferral and diversification benefits. Well, we need to know what is the overall potential maximum of that. Let's just say it's 1%. Well, if I charge more than 1% in fees and brain damage, I don't care how good your tax efficient thing is, it's worthless to me. And so right now, I think the only real games in town for concentrated stock is this solution, around 50 bips at scale, potentially, if you're a big advisor, maybe even get it lower than that.
And one thing to add there is we have wholesale discount for financial intermediaries. What I quoted was the retail rack rate for folks coming over the internet.
100%. And the bottom line is I don't see us competing against Goldman Sachs. They got no chance, right? They're 2-3 times as much, and they just don't have the infrastructure to deliver it as cheaply.
You guys already put them out of the white label business,
yeah, I'm not going to say anything
on.
about that. But yeah, don't mess with the Vanguard culture, people, because it ends badly for you typically. But there is something that is competitive marketplace. I'm a personal consumer of it, and that is this market neutral, long, short, tax loss harvesting solutions. And they are relatively affordable. They're also complicated and hard to understand, but that's just part of the game. But so I feel like this product or strategy or whatever the heck you want to call it, like we have to be very cost competitive because our real competition is that. And so I think if you go out into the marketplace and you're trying to solve this problem, it's in the end, it's going to be, AQR Quantino doing that or this solution. And there's different trade-offs you'd want to consider. And I'm not saying we're the best or the panacea or going to do everything better than everybody, but I think those will be the 2 solutions in the marketplace that are credible and affordable.
Yeah, I mean, it's like a flow chart, listeners. Like there's kind of different paths, choose your own adventure you could go down. And what we've always said on this podcast in years past is if you could almost always divide the asset management industry into like 2 columns, and there's the people on the left that in general, and I'd love to put all 3 of us in that category, but it's like, hey, we want to charge as low as possible and still keep the lights on, be able to retain talent and deliver an awesome experience and solution. And then on the other side, which is a lot of historical, parts of Wall Street that's a little snake oil, is like, how much can we charge and get away with it, right?
Exactly.
And not to demonize everyone in the past that charge high fees, because, high fees, look, if you're Renaissance, God bless you, you can charge $4 and $40, and if you deliver the value, go for it. But there's a lot of offerings out there. We hear AQRs flex a lot in these conversations, and we say, look, it's probably great. But there's some people out there that, hey, I don't want to look at a portfolio and have 1,000 positions. I don't want to have shorts. It's just too complicated. Like, just give me X, Y, Z. So there's a number of choices out there that are pretty great too.
One thing I would add to that particular point is both of you come from interacting with a lot of institutional advisors. Where I am in Silicon Valley, I'm dealing with a completely different set of folks that are not as sophisticated from financial planning perspective and are not really considering like an AQR's flex SMA strategy, most of them are doing nothing.
I like to call that the ostrich strategy. Head in the ground, close your eyes, just hope the problem goes away. See a lot of that.
Yeah, if you were doing that for the last 2 decades, it has worked out beautifully for you. Now you have a portfolio with so much gains you don't know what to do with. Many of these folks, they don't have to do anything because their equity is getting vested and it is getting put into this account. And the easy solution is to not do anything. If you go ahead and sell it, you now have a different problem of where to allocate that capital. So most of them just don't do anything. And that is truly the competition in my mind, which is that there's a lot of inertia that people have to overcome and realize how much risk they're carrying by putting 80-90% of their net worth in one stock.
There's so many use cases and investors that would benefit from this. I mean, the most obvious is concentrated, but the frozen direct indexing, we get a lot. We get a lot of family offices that reach out. They're always the most tax-minded people in the world. But theoretically, like, this could be an employee benefit. You could go to Uber, you could go to a lot of these companies and say, hey, by the way, we offer this service for your employees that will be liquidating or exercising their options, or all of a sudden, whatever it may be, and they have a lot of highly appreciated positions. This could be an employee benefit. Because look, I said this on Twitter. I've given a number of speeches in the past couple of months where we talk about 351s. And this is my least favorite thing to do as a speaker, but I say, okay, I want to see a show of hands. Anytime you hear that phrase, everyone just cringes and like hides. But I say, let's just be honest. Like, who's heard of a 1031? And this was a CFP organization. So the most educated financial advisors out there. Every hand went up, and I said, who here has heard of 351? As an example, and zero hands went up. There was 5, but it was at the Cambria table, so I don't count that. I'm like, you guys, why are you raising your hands? You're like, we work together. Like, just put your hands down. But the point being is that, like, if they haven't heard of it, then forget about corporate treasury or other companies and ideas that haven't heard of it. So, the baseball analogy, this isn't even inning 1. This is like the warm-ups and the pregame of doubleheader. I don't know. But there's some exciting applications to this for all sorts of people.
Yeah, I mean, I'll just emphasize that, Meb, because like we're still, and I'm sure you are, just explaining basic ETF tax benefits to people 30 years later. And, half the people you say, can you actually explain to me what it means when people say ETFs are tax efficient, but actually explain like how and why? They're actually like, I don't know. I'm just quoting what I heard on CNBC. So we're still working on like ETF 101 taxes. 351 is like varsity. And then 351 plus exchange fund is like PhD squared. And so, yeah, we're way out on the innovation curve, but we got to keep inventing these things because eventually people will come along with us, but it's going to be a huge road.
So, Wes, you've obviously done a bunch of these. We've done 2, soon to be 3, coming in September and December, 3 and 4, September and December, listeners. Let's hit a couple FAQs that I consistently get, and I'm sure you do too. And Sri, you can chime in for any that you are like the main questions that we always get. And the first hand that goes up in the audience that I always get, and they're like, I've never heard of this. Is this new? What if the IRS changes their mind? And my joke is always, well, we may not have an IRS in a year. Our government says there's going to be an ERS, but theoretically, if things continue on the way they are, I always say Goldman did one and they had $1 billion. And I said, Goldman's got much more expensive lawyers than we do, although ours aren't cheap, Bob.
Yeah.
But like, what's an FAQ that you get? Like I said, this has been in the tax code. 351's been in the tax code in its modern form. Like, what is that, 70 years now? Originally, I think it's almost 100 or over 100, isn't it? And exchange fund's about the same, isn't it? 50,
That's
60 years?
There's a great paper. I'm blanking on the name of it. I'll send it to you. You can put it in the notes. But actually, a guy goes back and looks at the legislative history of exchange funds, and it intertwines with 351. Because like these things are actually, they're like cousins. It's not like they're totally separate. It turns out they're naturally always together. And what I usually tell people is like, listen, If you don't believe me, there's this thing called ChatGPT or Grok. Go feed Grok or ChatGPT and say, hey, please go read the Section 351 statute and tell me about the Treasury regulations related to funding a RIC. And it'll tell you by statute what the law is. And all we do is follow the law. Just like Sri does. There's a statute, Section 721 on partnership and all the taxation and all that good stuff. Google it, man. And it's just, there's laws and we follow laws. Now, if the tax risk here is if we don't follow the law, we're not going to do that. Or if Congress changes the law and we don't control politicians. So that's what I always tell folks. Listen, we're just following the law. We do our best we can. We hire the best tax attorneys to follow the guidance. So if there's something that's like in between or unclear, but in the end, your risk is if your senator says, you know what, I think Section 351, see, that dog doesn't like senators, apparently. You know, you have to have
Politicians, come on.
Exactly. The risk is an act of Congress, which is always a risk. You know, man, remember they tried to do that, I don't know, 5-6 years ago. They tried to do a big hubbub on ETFs.
But it's the risk with every, so you can make this blanket statement about anything in the tax code, right? Like literally it changes every couple years. It's like the reason CPAs exist. It's the most complicated and nonsensical situation. We always tell investors and followers, say, look, it is your duty to pay every cent of every dollar of every taxes you owe. But it is also your duty to your family, your community, everyone else, that you shouldn't pay more. And if you do pay more, that means you are voluntarily paying more, which is okay. However, I have yet to speak to someone who voluntarily donates or tips and sends checks to the government and says, you know what, I owe 100 grand, I'm sending you 200, right? No one's ever done that. In the history, no politician has ever done that. Now you could, and there's nothing stopping you, but you're doing that inadvertently or unintentionally if you choose to pay more. And that could be a decision. You say, look, I feel fine. I'm going to pay more. Cool. But you play by the rules. We don't set the rules. And, you know, to me, we could do a whole nother podcast on what should the rules be. But like, look, if carried interest is going to keep making it through to all of these, it's like the cockroach. That thing is invincible. It's like Superman times 100. It's amazing. But on the list, we did a Twitter thread on this. I think you participated in, Wes, back in the day. And I was like, what's the most egregious? And so there's like 100 things that I think should get scrutiny way before, you know, helping people diversify, you know, and other types of ideas.
I mean, another important point to make is, do you not think the billionaires have all the tricks already and will always have the tricks? Of course they will. All we're trying to do is how do we democratize access with affordability, you know, try to get complexity way down and try to make this transparent to people. Like everyone should be able to use all the tricks that the billionaires use. Not just the billionaires. I mean, God bless billionaires. I love them too. But like, that's all we're doing. The hate should be on like, talk to your politicians or talk to the overpriced of the billionaires. But we're just trying to make this accessible to a much broader swath of the public so they can also have opportunity to invest tax efficiently. I figure that's like not a bad thing, but people can argue.
I think Wes and I talked about this like 15 years ago where I said, you know, look, everyone goes on CNBC and Bloomberg and loves to talk about, hey, what's gold doing? What's the Fed doing? Is our stocks expensive? Yada, yada. But the amount of tax alpha that you can generate that's so much easier than actual investment alpha is staggering, right? And I put fees in there too, because, you know, these are the two lowest hurdles to jump over versus, you know, hey, can I predict what the S&P? But what do people fixate all their time on and efforts? It's always the investment side and it's never the tax side. Like we had Savita on from Bank of America and they had a piece where they were like, just the tax benefit alone, tax and fees of moving from the average mutual fund to the average ETF is like 1.5%. And how many legacy assets are still going into these just dog crap products that charge a fortune and that are tax inefficient. By the way, Sri, one more FAQ. Can you guys only accept stocks? Can you accept anything else?
We accept stocks and ETF shares as well, just like 351. But
no Dogecoin?
No Dogecoin, no crypto.
No mutual funds?
No.
No hedge funds?
Yeah, we don't accept any partnership interests, publicly traded securities only.
What else on the FAQ? Anything else that you guys that's like, you're like, oh, I might as well answer this here because I'm going to get 1,000 emails about this. Anything else that people will want to ask?
One thing I would add to your previous question is there is no rule that says we cannot accept private stock. It is just something we haven't gone into, mostly because there is price discovery is a lot harder with private stock. It is just whatever value some private firm ascribed to it a long time ago, and there isn't constant market acknowledgement of that particular price. And there's always an endowment effect of like whatever the investor is bringing in, they think it's valued a lot more, and they don't think the other stocks are valued as much. So we haven't gone into private stocks itself, but that is something that we could explore with Hype.
Cash 2.0, we went down a rabbit hole last fall about looking to do interval funds because we were looking at this. Nothing drives me crazy. You see these offerings on the late stage private, and usually it's interval funds in the US because you couldn't really do it in the ETF, but that charge 4 percentage points. And I'm like, what in God's name are people doing? Like, that are paying 2, 3, 4% plus on these funds. And I said, you know what? Honoring, like this is Wes here. I'm like, we're going to be the vanguard of late stage or even early stage private. It's going to be seed to Series D, and we're going to do it for rock bottom cost. And then we went down the interval fund route, and I'm like, oh, this is complicated. This is really expensive. Let me go back to ETFs. It's way easier in the ETF land. This is like doing the valuations and doing all the audits and setting up the interval funds. One day, however, when we're managing all the money that Wes is, I was like, we'll probably launch something like this. But for now, it's in the too hard pile because it's solvable, but it's just solvable for another day, I think.
Yeah, we went down that rabbit hole as well. But to your point, 500 G's, annual cost to run one of those things, which means you need a lot of AUM to even get it to work. And we also looked at like maybe operationalizing it like ETF Architect, but there's also just not a lot of efficiency. Like it's, like we get a lot of efficiency when having more funds doing it all the time, but those interval funds are crazy, man. It's just not really susceptible to vanguardization, I guess.
The other flavor that a lot of people do is something like an SPV, where you just get a bunch of accredited investors and buy shares in a private company that is offering shares. But SPVs are also something that people should carefully read what the offering documents say, because there is going to be a lot of fees and carry on top of it for just buying this.
I've been railing about this. And look, a lot of the times I'm railing about stuff, listeners, it's not me trying to be holier than thou. If I see bad behavior or things that I think are predatory, I call them out. Like the SPVs drive me crazy because people are like, here's SpaceX. And for the benefit of getting SpaceX, I'm charging you 2 and 20. And I'm like, what in God's name are you doing? You're not doing anything. That is so bold to be like, I deserve 2 and 20 for rolling up a SPV for you to invest in this company. That's a $300 or $400 billion company. I was like, look, if it's a $10 million startup seed, yeah, you did something, and maybe you're useful to the company. Maybe you actually did the diligence and actually looked into it. On top of that, half the time, or I would say 99% of the time, the investors going into it don't even know what share class they're getting. So there could be like these giant overhangs and the company has to like 10x for you even to get your money back. I think there's going to be a lot of black eyes and embarrassing outcomes that I think most of them will just fade away. But every time I see one of those, I'm just like, oh, gross. I can't believe you have the gall to charge 2% just to do nothing. But,
yeah, well, that's akin to SPACs.
Rant.
They have all these different, I don't do academic research anymore, but they used to have all these papers like identifying overvalued equity. And like, it's all the things you'd expect. Like, people doing private offerings on like big deals and charging fees, like SPACs, issuing equity, like all the telltale signals of like, why would the smart money be doing that? Well, it's because they're trying to take advantage of a bunch of liquidity and idiots that, want to speculate and win. But it's just, we're just obviously in like a speculative high animal spirit regime. I don't know when it'll end. Hopefully never.
when the SPAC craze was happening, and you can go look back on Twitter, I was like, my friends at Loothole put out some research and the average return of the SPAC was like minus 70%. And I was like, you know what, I'm hopeful. Maybe this is a new democratization and these guys are putting out the best products and best companies at the best time. And I remember hearing my favorite comment was always like, number one benefit of a SPAC is you can make forward projections, whereas an IPO you can't. I'm like, that's not a benefit, by the way. That is like the ability to you to just jam a bunch of imaginary numbers in. And sure enough, they all went down 70% plus or whatever, which is a shame because it's just another, structure. It's just that you see people gravitate towards certain things, and it's like you just build a long list of stay away. So, for us, you guys know how to email me, as well as we have 351 education materials on all the Cambria sites, as well as cambriainvestments.com/tax. Gents, this has been a whirlwind, really fun. I'm excited. I think this is going to shift the plates of the industry. We'll do it again in a few months. Sri, Wes, thanks for joining us.
Thanks for having us.
Thank you so much, Matt, for having us.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.